My name is Brian Davis with AccuPlan, and today's webinar is going to be on investing in mortgage notes in your IRA or 401k. I'm very happy to have Robert Napolitano from Dream Capital going to be joining us in a little bit. First, a little housekeeping here for those of you that are on the call already. If you have any questions, please write them in the chat section or the raise your hand for a question section. We're going to try to get to as many questions as we can. We do have a lot of people on the call today, so if we can't get to everybody's questions, you'll be able to contact us offline. We're also recording this webinar, so if you're not able to stay on the whole time or you maybe joined late, you can email me afterwards and I'll be able to send you a link so you can watch the webinar at your own time. So while everybody's getting going, I might as well get started and get going here. Again, I'm Brian Davis with AccuPlan. We're a self-directed IRA custodian. Before I really jump in too deep, a little disclaimer. AccuPlan is a third-party administrator, and we do not provide any investment advice or endorse any products. Please use your attorneys, financial advisors before entering into any type of investment. Now that that fun legal stuff's out of the way, again, I'm Brian Davis with AccuPlan. A little background about myself. I come from a family of rice farmers up in Northern California. I decided I didn't want to be part of that business, so I went to college at UC Santa Barbara and graduated in 2001. Shortly thereafter, moved to San Diego. I was in the mortgage business, doing loan originations through 2007 when the market kind of hit a little snag there, so to speak. I'm sure most of you guys heard about that. Then I did life insurance for a year or so before getting into this business doing self-directed IRAs over 4 years ago. During that time, I've opened up around 1,000 IRA and 401k accounts and helping people that want to invest those retirement dollars in alternative assets like real estate, notes, private placements. AccuPlan is the third-party administrative wing for our custodian, American Estate and Trust. So I'm a representative of AccuPlan, and we provide self-directed IRA and 401k administration and products. And they've been in the business since 1994. We've had our own custodian and trust company, American Estate and Trust, since 2007. So for those of you that don't know much about the self-directed IRA, you're not alone. A lot of attorneys and accountants and financial planners, they really weren't properly trained on all the investment choices for your IRA. They specialize in securities, stocks, bonds, mutual funds, publicly traded assets. That's their specialty. They're the brokerage houses, the insurance companies who have annuities. They don't really focus on things that are outside of that realm. And that's where third-party custodians like AccuPlan with American Estate and Trust come into play to allow people to direct their investments into everything allowable under IRS guidelines. At the end of 2010, there was just under $5 trillion in IRAs. About 98% of that was with the traditional brokerage houses. Only 2% in an IRA that would allow you to invest in things like notes and real estate. That number is on the rise. A lot of popularity was gained when Mitt Romney was running for president last year, and it came to light that he had a self-directed IRA worth somewhere around $100 million. Now, if I had all the answers to know how to do that, I wouldn't be here today. But it did gain a lot of attention to this space and let people know that, hey, there's other options out there for you. If you're not looking to invest in the stock market, you don't have to. If you understand the world of real estate and notes, it's available to you as well as to your IRA. So hopefully you can learn a little bit about that. What we mostly see are these top 4 asset classes: real estate, notes, loans, investments in private companies, non-publicly traded companies, and precious metals. Now, I personally don't see too many precious metals. I mostly deal with real estate and notes, but that's also a big part of the self-directed IRA. A huge list here of different types of investments: trustees, raw land, lease options, joint ventures, promissory notes, private placement. This list can go on and on and on. The IRS never made a list of acceptable investments, just what's not acceptable. And they really only listed two things in their guidelines. And that is life insurance contracts and what the IRS deems as a collectible. And this slide right here kind of shows some examples of what they deem a collectible: a work of art, rug or antique, metals or gems, an alcoholic beverage, anything illegal. There's even some exceptions on coins with certain U.S. government-minted coins. You'll also hear that S-Corps is not allowed for the IRA, and that's true as well. That's an S-Corp rule. They don't allow IRAs to become members of them, as opposed to an LLC or a partnership or a C corporation. So those are kind of the three things. Now, it does get a little trickier than that, and so what I want to talk about here is what's called a prohibited transaction. So besides those three investments that you're not allowed to make, there's some certain type of transactions that you're prohibited from making. And the basics of this is there's no self-dealing. And if anybody wants to look up the tax code for these prohibited transactions, it's in Internal Revenue Code 4975. So what that means is you really can't have any transaction between yourself and the IRA. And besides yourself, the IRS deems these disqualified persons as your spouse, and then family members in lineal ascension and descension. And that just, you really want to think of it in a straight line up and down. Parents, grandparents, kids, their spouses, grandkids, their spouses. Side to side can be okay as long as they don't fill any one of these other roles here, if they're a fiduciary of the IRA, if it was a qualified plan. Another thing that always look at, your company or a company that one of those disqualified persons owns that they have the majority ownership of, your IRA also can't do business with them. So you can't buy property and rent it out to your college-age kid. If you have like an investment property, you can't take your IRA and then put that inside your IRA. It has to be a new transaction. So if anybody has any questions about that, again, please let me know. Write them in the chat box here below. So the next part is, how do we put money into a self-directed IRA? Well, self-directed, it's really just a marketing term. We have all the same type of IRAs that the brokerage houses do. We have traditional IRAs, Roth IRAs, simple IRAs, SEP IRAs, and even the solo 401k plan. So if you have an existing IRA, we would open up the same type of IRA with us, request what's called a trustee-to-trustee transfer, move that cash from the other custodian to us to allow you to invest in things which you have more control over. If you have an old employer plan like a 401k or a 403b, you can do what's called a direct rollover. You're going to direct that plan administrator to move the funds to your newly created IRA with us. I get a lot of questions here, well, what about my current 401k or my current qualified retirement plan? Can I move that over to an IRA? The answer to that is maybe. A lot of these qualified retirement plans, especially 401ks, when you're in the plan and you're under 59.5, you're pretty much locked in that plan until you leave the company and leave the plan. Some plans allow what's called an in-service rollover, which means you can actually, while you're still in the plan, roll over some of those funds or all of those funds to an IRA or another qualified retirement plan. So you might want to ask your plan administrator if that's something you're looking to do. The other option, of course, is to make an annual contribution. From what I understand, I don't think the 2014 limits are changing, but I haven't read any recent articles on it at all. Oops, I see a discrepancy here. But the contribution limits for an IRA are $5,500 a year for the traditional or Roth IRA. And if you're over 50, you can throw in an extra $1,000 there. Now, there are some constraints based upon people's income. You want to talk to your CPA about that. Another plan is the simple IRA, which is for small businesses where an employee can put a little bit of their funds into the plan, similar to a 401k, and the company can match. The cap limit on that is $12,000. And I apologize here, didn't update this slide, but the SEP in the individual K is supposed to be $51,000 as the limit there. And a SEP IRA is a self-employed pension. It's for the self-employed individual who want, and perhaps their employees, that works just like a traditional IRA, except they can contribute up to 25% of their adjusted gross income with a cap at $51,000. An individual K or solo K, solo 401k, you might hear it called, is another product we offer. So if you're a sole proprietor or incorporated with no W-2 employees, you can have your own 401k plan. And that's something that we help you provide as well. You can make contributions just like if you were an employee with a company that had a 401k plan. You can make employee deferrals to the plan, and then you as the owner of the company can make a profit-sharing contribution. The limits on that is $51,000. Unfortunately, I did not update the slide. I apologize there. If you're over 50, it can be up to $56,500 a year. And I'll get into some of the bigger benefits with the solo 401k in a second here. So the solo 401k works a little bit differently from the IRA. So again, if you fall into that boat where you're self-employed and have no W-2 employees, this could be a great plan for you. These plans are what's called self-trustee plans, meaning you are the trustee of the plan and the administrator. The 401k plan gets its own tax ID number. So you can go open up your own bank account for your own 401k plan and attach it to your corporation, or if you're just a sole proprietor, to yourself, and then invest directly from the 401k plan. So you have checkbook control already. With the IRA process, it's a little bit different. You open up an IRA, and you have to have an IRA custodian, which is what the role we play. And you fund your account via the methods we talked about, the transfer, rollover, or contribution, and then direct us to fund the investment, and then your assets in the account. What a lot of people do here, especially in the note buying world, is they create what's called a checkbook IRA. And the checkbook IRA has been popular for the last 15 or so years, in which your IRA creates an entity. So there's two prevailing models. There's an LLC model where the IRA becomes the sole owner of the LLC, becomes the sole member, and the IRA owner becomes the unpaid manager. In this instance, the IRA invests in this LLC, and the LLC then can go and invest in notes. And this is one of the more frequent approaches. Now, I'm in California. I know a lot of you on the call are from all over. California, to operate an LLC in the state, there's a $800 a year fee plus a gross receipts tax. And so the LLC model isn't for everybody. So there is another prevailing model out there, which is called a business trust. The business trust model works very similarly to the IRA. So the IRA becomes the beneficiary owner of the trust, and the IRA owner becomes an unpaid trustee. Because it's a trust and it's a single member entity, it's just like the LLC. It's a pass-through entity federally, so no federal return has to be filed. And because it's a trust, it doesn't have to, and a single member, it doesn't have to file a state return. So it doesn't have to pay the California Franchise Tax Board fees of $800 a year plus the gross receipts tax. So if anybody has any questions about the checkbook IRAs, feel free to let me know. And again, I have my contact information here, Brian Davis with AccuPlan. You can find out more at AccuPlanSanDiego.com. You can check out more about the checkbook IRA at retirementcheckbook.com. And again, if you have any questions, please write them in the chat or the questions section. And with that, Robert, are you there?
I'm here.
All right, I'm going to turn this over to you.
Okay. You can see my screen?
I can see you just fine there.
Okay, Brian, thank you very much. Thanks for inviting me on the call today.
No
I'm excited about the environment we're entering into in this new world of real estate and finance. A lot of things changing in the environment. It's going to have a lot of impact on the business, and I'm going to show you today a little bit why I'm excited about, the mortgage note business. So a little bit of a background about myself. I'm over on the East Coast. I'm in sunny New Jersey today watching the leaves change on the trees outside my home office today. So if I talk a little fast, I apologize. It's just I like to talk fast and I think fast. So I'm going to run through this. I have a lot of information I want to share with everybody today. So I'm going to try and keep it all within the next 30 minutes. So I may rush through some of this, so I apologize if I'm going a little bit too fast. So first I want to get my disclaimers out of the way as well. Dream Capital, our principals, members, and officers, attorneys, managers, operating managers, and directors, collectively as Dream, are neither registered investment advisors, mortgage brokers, real estate brokers, broker-dealers, securities dealers, financial advisors, or with any state or federal agencies within the United States or any other country. Please understand that you agree that no information contained in this content constitutes any legal, accounting, or tax advice of any kind. You should contact an attorney or an accountant before using any of the information described in this correspondence and content for your business, company, or transaction you're involved in or contemplating to get involved in. The content herein is intellectual property of Dream Capital and may not be copied, circulated to any third party in any way, shape, or form, or matter, in part or in full. Please note that the investor profile may be used for Dream Capital, its investments, or affiliate companies. Past performance is not guaranteed to future results, and you understand that you can lose your entire investment. Good. Now that I got that out of the way, let me tell you a little bit about myself and who I am. Oh, let's go here real quick. Here we go. Okay, so my name, Robert Napolitano. I'm a real estate equity and debt investor, private lender, consultant, advisor, national speaker. I am a American Bar Association certified paralegal, and I have done expert work, and highest I've gone to the Supreme Court of Massachusetts to help them in resolving some litigation cases as well. Okay, I am also a faculty member of what's known as lawline.com. I teach attorneys the legal facets of mortgage-backed securities and foreclosure laws and how the real estate world is changing with all the laws. As you see over there, I've taught over 1,200 attorneys, and I am allowed to give them, accredited in 11 states, to give them what's called continuing legal education credits, so they get credit to keep their license moving forward. Here's some of the things that some of the attorneys have said about me and some of their comments and going through some of my courses online. Okay, so here's what we're going to do today. I put a little agenda together. Again, it is jam-packed with information, so I'm going to go a little quicker so we can get it all in the time frame allowed. But this whole presentation is going to be an introduction to mortgage notes. There are so many different facets of this business we can get into. We're not going to get into all of the little nooks and crannies, but I am going to go into certain parts of it and try and give some detail because I like to add value to my attendees and the people that are listening. So we'll go through some basics, some similarities between mortgage note investing and real estate investing, and I try to put this presentation together to do a comparison between real estate investing and mortgage note investing, because in my opinion it really is the same business. There may be some nuances that are different when you're going from the debt side to the equity side. There may be some changes in terms, but really the business is really going to be the same. And I like to do some comparisons to the two and make some correlations, and you'll see as we go through. We'll go through why mortgage note investing is so profitable. We'll go through some strategies, advantages in lien loading versus landlording, some of the risks involved, and you will go through a little bit of analysis to see if mortgage note investing is for you, because it isn't for everybody. Okay, and then we'll talk briefly on how to get started in mortgage note investing. Okay, so let's just go right through it in an introduction. So some basics. As I talk to people throughout the industry, whether they're in the professionals or consumers and even attorneys, I come across, it's amazing just the language that's used and what people are saying and what we think we understand here. I ask people all the time, if you have a mortgage on your house, do you pay a mortgage? And most people think they pay a mortgage. And we don't pay a mortgage. See, here's the three basic instruments, right? The ownership instrument is a deed. That just shows us who owns the actual real property. A security instrument is either going to be a mortgage or a deed of trust, depending on what state you're in. All of the property laws are governed by every individual state, and each state may handle certain transactions differently depending on the state. So some states will have a judicial process in order to foreclose, and some states will be a non-judicial process in order to foreclose, and some states have a hybrid of both. But in whichever state you're in and whichever state you're investing in, there is a process to take the lien position of the note to get over to the property and to get the property away from the debtor if the note's not being paid. And the instrument used, depending on where you are, is going to be a mortgage or a deed of trust. So for the intents and purposes of this presentation, I'm just going to use mortgage as the term, even though if you're investing in a state like California, they use deeds of trust. But it's really going to be the same thing. We're talking about the security instrument, and the security instrument is really what I call the glue between the negotiable instrument, which would be the promissory note, because that's what we pay. We pay back a promissory note. When somebody lends us money, we pay them back on a note with interest, and that's it. It's a debt. It's a contract. That's what we call a negotiable instrument. And so the security instrument is the glue that attaches the promissory note to the deed. That's all we're doing. If the security instrument wasn't in play and we didn't have a security instrument in the equation, then we'd be talking about unsecured debt, like personal loans, like credit cards. Okay, those are unsecured debts. But in our case here, this is going to be a debt that's going to be secured by real property as the underlying collateral, and we're using security instruments to secure the debt and either a mortgage or a deed of trust. Okay? So what is a bundle of rights? A bundle of rights is the rights that property owners get whenever they own property. And this is the whole list of bundles of rights. What we're going to talk today about real quickly is going to be the mortgage. Property owners have the right to mortgage their property. What that really means is that right that I have when I own real estate, I'm allowed to pledge an interest in my property that I own for the trade of money. So I can give someone an interest in my property if they're going to give me money. This is how it works. We typically know what we see on the screen here, I put at the top there, is a primary marketplace. There's basically two marketplaces where we transact business in the mortgage business. The primary marketplace is when a business interacts and does a transaction with the consumer. And you'll see in a second, the secondary marketplace is when a business does business with another business, a B2B marketplace. And the primary marketplace is a B2C, from a business to a consumer. So when originating notes with consumers, what we typically know is, see, the mortgage is actually with the property owner because it's a right. When the property owner wants to get money from a bank, the bank will give them money, and the property owner will pledge the mortgage and attach it to the note. That's what's given to the bank. So a bank doesn't give a mortgage. It's really a homeowner and a property owner that gives their mortgage to the bank in the trade for cash, and in the form of a promissory note that they're going to pay back over time with interest. Okay, so that's how it works. So getting our terminology straight is the first thing I want to talk about. Okay, so when they make a mortgage and a note together, they usually trade at these banks on a secondary marketplace. And then a servicer usually comes into play, and the homeowner or the property owner usually pays a servicer, and that money goes into this big black hole we call a secondary marketplace. Okay, so I'm going to pull back the curtain a little bit. Here's a real basic model of what the secondary mortgage marketplace really looks like. Usually behind the servicer there's a master servicer, and usually there's a big banking institution that does a number of notes and pulls mortgages from people and pools them together. Okay? What we're talking about today is becoming that banking institution. How do we become that banking institution and take the place of the bank? How can we become the bank? Because it's very profitable becoming the bank. Okay? And so we can be, as individual investors, we can hold some of these notes, usually in the individual capacity or in a pool, or there's also the model of having an investment fund where funds will hold pools, individual notes, whole notes, fractional notes. There's all sorts of ways money can be made inside of an investment fund. Okay, but in any case, I have that dotted line in the middle because there really is two players on the four corners of that contract. Okay, it's really a debt contract, a credit contract, and there's always a debtor and a secured creditor. Okay, there's only two players. I want to make it real simple. So when you're buying these things, what are you really buying? Are you buying the mortgage or are you buying the note? Well, let's look at the two. Okay. First, I want to go through what is really the value. Let's talk about two different things first. We're going to talk about a performing note and a non-performing note. A performing note would be a note where the debtor would be paying on the note as according to the terms of the note. A non-performing note would be someone who wouldn't be paying on the note according to the terms of the note. Okay, so let's look at the value of a performing note first. It's real simple. Okay, and for all intents and purposes of my illustrations, I'm going to leave this real basic. There's a lot of little nuances that I'm not going to go into, and a lot of little details that I'm not going to go into because it would just take up too much time. So we're going to keep them real basic. Okay, so if we had a $200,000 note, that UPB under the $200,000 I have there is what we call the unpaid principal balance, and it's real simple. A $200,000 note, the four corners of that piece of paper is really going to be worth X amount of dollars at maturity. So if it's a 30-year fixed rate note at 12%, you do a simple amortization table and what the paper is worth over time. Real simple, okay? So it's easy to evaluate that note. But now let's say we had a non-performing note. What is the value of a non-performing note? Well, here's where it gets tricky, and here's where it gets very lucrative, okay? We're going to start jumping into this now. Okay, so what I have on there, the value of a non-performing note, they have all these little bells and whistles. Yes, we have the unpaid principal balance. In this case, would be $200,000, and then we also have what's called arrearages. So if someone hasn't paid, we'll say for 3 years, we'll call it. Well, it doesn't mean that you're not getting paid, but it's still accruing interest in the form of arrears. Okay, so the interest will still be accruing. You may even have, depending on how the note is set up, you may even have default interest where the interest rate will be accruing at a faster rate, so it puts on more value to the paper. You'll also have your costs and fees involved, and that PG, depending if you're in residential or commercial. In commercial, it's very common to give personal guarantees, so you may have an attachment to the debtor's personal assets if they even have any more assets as well. And there are certain cases where they do. Okay, so in essence, what I have here in my example, that the real value of the paper, even though its face value was a 200, okay, what happens to the paper over time, it really gains more value because it has gone non-performing. Okay, so what is the value of a mortgage then? Well, the value of a mortgage could be one of two things. It's either going to be the value of the collateral or the debt owed. Now think about this, okay? Let's look at this. Let's say that $250,000 non-performing note is against a property of that's worth $175,000. Well, you're really only secured against the underlying collateral in this case. So this is what we call upside down or underwater, right? So your mortgage, the value of your mortgage in this case is really going to be the value of the collateral. It'll be at $175,000. On the other side, let's say this loan of $200,000 had been performing for 15 or 20 years, and they actually paid it down to $100,000 at this point. Something had happened, it's typical hardships, whether there's a loss of income in the household, death in the family, medical, whatever the hardship is, whatever event happened in the debtor's life at this point, 15 years had gone by, they paid down their principal down to $100,000, and all of a sudden they can't continue to make payments at that point. Well, in this scenario where the unpaid principal balance is less than the value of the property, where there's equity in the property, really the value of your mortgage is only at $100,000 or the debt owed. So you can only recover what you're owed. So even if at this point, if in the unfortunate case, if you had to foreclose on this property, you would get your unpaid principal balance, your arrearages, costs and fees, and you would take back the property. And if you sell it at $175,000, you only get back what you're owed. The rest would have to go back to the homeowner, the property owner, or the debtor. Okay, so the value of the mortgage and the value of the paper changes as soon as the paper ages. From day one, the values change. Even though their face say what they say, even in recorded systems, the value of the paper changes from day one. So let's look at some money-making strategies, generating growth and income with mortgage note investing versus real estate investing. So I put a little chart together here, and here's where the comparison comes in. Growth and income strategy. So we're all investors here. So we either want to grow our nest egg and make more cash, or we want to create some income. Those are the only two things we really want to do. So in real estate investing, sometimes we want to do quick flips, right? We want to make some quick cash and make some lump sum growth in our pocket. So we do quick flips, whether we do wholesaling, optioning, double closings. That's what we do as real estate investors, right? We can play the appreciation game or take losses for our tax advantages, right? We can hedge against inflation. We can do market speculation. We can play the equity game, or We can buy and rehab, right? We can buy the property at a discount based on a distress and then bring the asset back to performance and intended use. I mean, we're basically just rehabbing the property and selling it at that point, right? On the income side, we're generating rental income. It's real simple. You create residual income, and we can get that out of the buying and rehabbing. Instead of selling it, we can hold it. You know, there's a whole bunch of ways we can get to the actual property, but, rental income, and there's also all sorts of ancillary services we can add onto our rentals as well to generate passive income. Okay, so on the mortgage note side, it's really the same thing. We can quick flip notes. We can create equity inside of notes. We can take losses in notes. We can buy notes and rehab notes, and we can also, on the income strategy side, create income from interest payments. So that's simple. Okay, so it's really the same business, but it's a different asset class that we're using to generate our business. Okay, so how do we buy and rehab notes? Well, this is what we're going to talk about. Here's one of the major differences. Instead of rehabbing property, what I'm going to show you today is how we rehab paper. Okay, we can modify the paper to get it to reperform. We can mark up the paper and sell it at a markup. We can convert it from debt to deed, and that's where we're going through our foreclosure process. Or we can get taken out by a refinance. They can get conventional financing, which is not too common in today's marketplace. Okay, so these are some of the things that we can do to rehab paper. So I've always been asked the question, well, which is better, performing or non-performing notes? Well, that's going to depend on what your investment strategy is and how active you want to be involved in the notes. If you don't want to get too involved in rehabbing the notes and you want to just have some passive income, well, your performing notes is what you really want to buy and put inside of your self-directed IRA and live off the income of the payments coming in. Non-performing notes are going to require more work and more effort on your part if you wanted to get involved in that. First lien position or second lien position. There are advantages to both. What I'm going to be talking about today is going to be first lien positions, but there's a whole world of investors that go second lien positions, and there's a model that works there. It's a little bit of a different business. The main difference is when you're looking at first lien positions, you're really looking to rehab the property and the situation. On the second lien position, you're really looking to rehab the borrower. So your investment and your targets are going to be two different things. So residential or commercial notes. I'm more partial to commercial notes for my own personal reasons. I think there's more money to be made in commercial, and you don't have the same liabilities in dealing in the consumer world, because the consumers have a lot of protections helping them protect their interests as well. But that's just my personal preference. So why is it so profitable? Well, for the purpose of this presentation examples, I'm going to use first lien position, non-performing residential mortgage notes. So let's do a couple of examples, okay? So I'm going to go through some strategies and some of the similarities and differences between real estate and mortgage notes. So let's go again to real estate investing and mortgage note investing. Okay, how do we generate income? Well, on the real estate side, we get rental income. On the note side, we get interest income. So we can do quick flips on the residential side by selling the property and generating cash and putting it into our bank account or our self-directed IRA at this point, right? Same thing with investing in mortgage notes. What we can do is we can take them, do a quick flip, mark them up, and then put money right back into our self-directed IRA. Well, we can play the appreciation and loss game on the real estate side. We can hold the property and wait for market conditions to change as they are today as we have this presentation, and we can acquire some more equity and appreciation. Well, it's the same thing on the note side, and I'm going to show you how we gain equity inside of a note. It's really going to be not so much in the appreciation, but it's going to be in the discount in which you purchase creates equity spreads. But you can have equity inside of a note, okay? Now, on the real estate side, again, we can buy and rehab. We can buy and rehab a property, and here's what we're going to do. We're going to show you an example. This is what we know how to do, right? We usually buy stuff on a short sale. The property is worth $175, and the outstanding balance is $200. This is the example that I used before. So this is typically what a fix and flip rehabber would do, right? You buy the property, and you buy the property at $175,000. Usually you put 35% down, you go to a private lender, get your 65 LTV, and you're putting in $61,250. You're using $25,000 to repair the property. Your capital costs, because it's going to take you 6 months to do this, we're assuming 6 months at 15%, 5 points at 15%. Your capital costs are $14,000, and you can sell the property at an after repair value of $275,000, and you're making $60,000. Okay, wonderful deal. Okay, so once we sell it at 275, you pay off your lender with interest, you recapture your costs, you have your commissions at 5% with your realtor, your closing costs is estimated by $5,000, and you've made $42,031, and your total invested was $100,469, giving you a return on investment in 6 months, 41%, almost 42%. A great deal. You've done well with your money. Assuming you can do that twice a year, you're making over 80% on your money. You're a wonderful rehabber. You're doing great stuff. Okay, we know how that business works. Let's look now on and you sell the property and you make your money, or you can sell the property and hold it for rental income as well, depending on what you want to do inside of your portfolio at that point. Okay, now let's buy and rehab and modify to reperform on the paper. Same example, okay? Now we're going to fix and flip the paper. How do we fix and flip the paper? Same scenario. $175,000 is what the house is worth. The unpaid principal balance is $200 at this point. But we buy the mortgage note, right? So we buy the mortgage note typically based on BPO value or value of the collateral. So in this case of $175,000, we're going to pay 50 cents of value. So that means, well, let's go back here a second. Right. So the papers were $250, as we said before, with all the arrearages, costs, and fees, and maybe a personal guarantee. So we buy the paper at half of the collateral value, half of the property value. So at $87,250 is what we buy the paper at, right? Now look at what we've done. I've now created an equity spread on the property, right? Because now I'm into the property, I'm into the paper at $87,250. So now that I'm only into the paper for $87,250 and I have some equity in the property, I'm now at 50 LTV. What can I do? I can do a lot of things at this point. I call up the homeowner, talk to them about their finances. Let's see what we can do to get this paper to reperform again. Well, they couldn't make, $1,500 a month payments, but they can make $700 a month payments. Okay, or they can make $800 a month payments. That's great. So now I can redo the paper and remodify the paper, and let's say I knock it down to half of the payment. I grant a 50% reduction in their obligation and modify the mortgage accordingly. So the $250 that they owed me, and they understand they owe me $250. If I tell them, well, now you only owe me $125,000, they're ecstatic and they can pay on $125,000. What have I done here? What I've done is I've created equity in the note now of $37,750, because remember, I'm into it for only $87,250, and now they've created a new debt for $125,000 with a new mortgage, and remember, see the value of the mortgage changed now as well. New mortgage, and now they got new payments going on. I've gotten this loan to reperform again because based on their income, based on their financial situation, they can afford payments on $125,000, not the $250 in which they owed me. Okay? I can sell that reperforming mortgage note at 90% of value. Okay? So that's $112,500 I can sell, making a gross profit of $25,250. I can do that, assuming I can do that every 45 days. The one transaction is going to give me almost a 30% return on my money, and look at what it does if I can do this 8 times a year, assuming it takes 45 days to do this. Okay, now the numbers, again, the numbers are for illustrative purposes only. I just want to show you what you can do. I'm trying to illustrate the principles of what you can do with the paper. Okay, the numbers are always going to vary. There are so many different factors that go into your return on investment and how long you can turn the paper, how quickly you can turn the money and turn the paper and do all these things. Obviously, you're going to increase your annual return. But this was just for illustration purposes only, that I wanted you to see exactly what you can do by buying at such of a discount and passing some of the savings on to the debtor on the other side of the paper and creating new paper. You're creating this profit out of nothing. Okay? So that's rehabbing paper with modified to reform, and I sell it and I put money back in my self-directed IRA. So let's say now I want to hold it instead of selling it. I can put that in my self-directed IRA, and I can take these $700 or $800 a month in income and collect on that income for the life of the loan at that point. Okay? Well, let's say I wanted to mark it up and issue a discounted payoff. How does that work? Okay, so again, we're back to the same scenario where I bought the paper at 50 cents of value. So it cost me $87,250 to buy the paper, right? and accepted a discounted payoff at 80% of value. What does this mean? It means that there's somebody on the other side looking to do a short sale, and they want to take $250,000 that's owed to me, and they want to give me a short pay. Okay, so let's say I give them a short pay of $140,000, which is 80% of the value of the house. So if it's an investor coming in, and this is a house that needed to be rehabbed as we did before, they can put $25,000 into it, sell it for $275, and make all that money. Well, aren't they going to make a bigger spread now as opposed to acquiring that property at $175? Now they're getting into the property at $140. Okay, so I can approve a short sale and still make a profit on my money. Here's the beauty of this as well. The nice thing about debt. So I made my $52,000 in profit just by issuing a short pay. I also have a $110,000 deficiency that there is an active secondary market for this as well, that I can sell this deficiency if I wanted to. So this leftover piece has value if I wanted to sell it. Okay? But let's say I didn't sell it. I just made my $52,000. Again, I did that pretty quickly as well. Let's look at the numbers here. A 60% return on the transaction. Again, if I can do that within 45 days, 8 times a year, I'm almost at 500% return on my money. Okay? Let's look at the next way we can rehab. I can just mark it up and sell it, right? That's a simple thing. Now let's do the debt to deeds. It's real simple. We do foreclosure or a deed in lieu. Okay, and all we're going to do is convert the asset class, in this case is what I call it, right? We're going to do the debt to deed. Same scenario. I'm into the paper and the lien position at $87,250, and let's say we do employ my cash for keys program. I'll pay for the deed. I'll pay the homeowner $10,000 for moving expenses, make it 20, make it 30, whatever it is. I have room inside of my spread on the debt to give them whatever makes sense. But let's say in this case they give them $10,000 to give me a deed in lieu. Now it cost me $97,250. They're out of the house. I have the property, didn't have to foreclose or anything, and I sell again the property at 80% of value to that same rehabber. I've now made $42,750, and again, same thing, assuming I can do it in 45 days, 43% return, $351 for the year. So again, the point of me doing this is to show just how it actually is the same business. All we're doing, instead of rehabbing properties, we're rehabbing paper. And that, so now we're taking the paper, converting it to another house, putting it into my my stable and my portfolio. And again, the last part is it's not really active today. If people want to do refinancing and cash me out on my note, pay me off, and it's just more money back in to my self-directed IRA. So with these methodologies and these principles and these strategies, it creates a business where I can accomplish growth and accomplish stable income, building a sustainable business over time. So what are some of the benefits? Okay, so what are our options here? We can put money inside of CDs, stocks, and bonds, and I think we've all seen this as well. What are they really paying today? Okay, they have different downsides. The CD is not paying much, even though there's low risk. Okay, stocks have a variable interest rate depending on how well you do in the equity markets, but it does have high volatility and there's high risk in there. And you're only getting virtual paper anyway. I always love that as well. And the bonds, same thing. There's variable interest rates depending on what type of bond you're investing in. There's various underlying assets. That's why I like the mortgage notes. You're getting some nice returns, and these returns again are conservative. Okay, but you're low and moderate risk. You're secured by real estate. They're for fixed terms. There's no commissions on them either. Okay, so that's one of the upsides. So why is it better to be a landlord versus lien lord? I always like to tell this story as well. If I'm the bank and I'm working with an investor that has a 4-family unit, a 4-unit multiplex, and let's say each unit is getting $1,000 a month in income. It's $4,000 they're getting in an income, and their mortgage payment to me is $3,000 a month. Okay, ultimately what that really means is that I'm their money partner. And ultimately, between the bank and the landlord ends up becoming my collection agent. That's all he is. He's going to collect the rents of $4,000 a month, and out of $4,000, he's carving out $3,000 and giving it to me. And what happens if 2 of the units go vacant? He's only collecting $2,000 a month. I'm still getting my $3,000. And what happens if, there's a problem with the tenant, there's a problem with the toilet, there's a problem with the hot water heater, or anything that goes wrong with the property? He's being called. So essentially, I'm really controlling the property without owning it, and the landlord ends up becoming nothing more than my property manager. That's really the way I look at it, okay? By being a secured creditor on the liability side, there is no liability that can attach to my note. I'm a lien holder. The liability can attach to the real estate, okay? And going back again, responsibilities. I don't have responsibilities for tenants or toilets. I have very low overhead, and therefore my profitability is better. It's very scalable, and I maintain control in the asset, and it's very liquid. So that's one of the advantages of being a lien lord versus a landlord. So some of the similarities, okay? What are the parties involved in buying those? Same thing. It's real simple. There's a buyer and a seller, just like there is on real property. The difference is on the asset maintenance, instead of having a property manager, you have a mortgage servicer. Are they insurable? They're both insurable assets. Yes. You do due diligence. Yes, there's some due diligence. There's less due diligence that has to be done on the mortgage side. Of course, you have to know what you're doing with that as well. Is this investment susceptible and exposed to the changes in the real estate marketplace? The answer is no. Well, there's a very low exposure, because remember, the marketplace is trading on the real estate. The real estate market has no bearing on the debt. Okay, the debt, you owe what you owe, Okay, the exposure that the paper has is by interest rate exposure and where the interest rates are going. But as far as the volatility in the real estate marketplace, the debt side has no exposure to that. Okay, is there overhead? There's always overhead, but on the debt side, it's very minimal overhead. Okay, transfer fees and taxes when we're trading the paper. Nope. But there is, in certain states, in certain places, transfer fees in trading the real estate. So some potential risks. Foreclosure could take longer than expected when you're owning the paper. The borrower could file for bankruptcy, which is not necessarily a bad thing. Consumer claims can be attached to the debt. But I want to say that with every investment, there's risk, and risk is an essential precursor for reward, the natural context for any great endeavor. Nothing that matters is ever built without risk. There's a side of risk that's more valuable and more rewarding. The upside of risk. The upside is the advantage of risk well managed. It is the insight to see what others don't and to unlock the opportunities others can't. It's visibility in unfamiliar territory. It is certainty in acquisitions. The upside is strength in the face of the unthinkable, the unknowable, the unexpected. It's a plan, a set of givens, a team of experts. Above all, it's confidence, allowing you to do the things you simply can't do before. In every risk, there's an upside, if you know how to look for it. So here's the upside in buying some of these things. Consumer claims may be used to your advantage. Discounts provide exceptional points of entry into the real estate market. Alternatives to foreclosures are available. Deeds of trust allow for quicker processes, and the fully secured by real estate, there's cash flow and debt, real estate are all insurable. Personal guarantees give you more options to recover. Receiverships are available to collect and rent income. Okay? Why is it so profitable? Because it's a secured investment. Your discount spread preserves your investment, and the time value of money makes the upside potential outweigh the downside risk. So, is it for you on this phone call, on this webinar? We don't know. Are you looking for growth, or are you looking for income? Are you looking to be an active investor or a passive investor? What's your risk tolerance? These are the questions you need to ask yourself to see if it is for you. So let's look at how this really works. So if you were looking at your capital deployment through AccuPlan, you'd want to have your money deployed either in an active growth strategy, an active income strategy, or in a passive growth and income strategy. And if you, depending on what you are and what your tolerance and what your appetite is, these are the things you would look to do. If you're in an active and growth strategy, you want to be brokering notes, buying non-performing loans, and rehabbing the non-performing loans. If you want to be active and look for income, then you want to buy performing and or reperforming mortgages notes and collect the payments, or you want to buy non-performing notes, rehab them, and hold them for interest income. If you want to just be passive and not get involved in all of it but still want to have the benefits, real simple. You invest in a fund for a fixed income return. So how do you get started in these? We're winding down to my last couple of slides. We're running out of time as well. So you can invest in whole loans. You could, but here's what you're going to have to do when you invest in whole loans. You're going to have to worry about the origination and the deal flow, getting the deals. We're looking at the right deals and making sure you got enough deals on the table to spend your money wisely, to have enough capital deployment to be profitable. Okay, then you got to go through the acquisition process, and I'm going to show you what that is in a second, where you're really going to have to look at your due diligence, and then you're going to have to manage your loans, and that's really where a servicing company comes into place. You can choose to self-service your loans, or you can hire a third-party servicer as well, and then your disposition. What are you doing with the paper once you've either rehabbed it, once and once you've acquired it? So what's the acquisition process like? Well, it's simple. You got to do a vetting and a papering process. It means you have to really find who your sources of a paper are. There are a lot of brokers out there. There are a lot of daisy chains out there. There are a lot of people that think they're in the business and they're really not. So the vetting process has to be thorough. You have to make sure you get to the real owners of the paper. Okay? Then you do your indicative bids or offers. You do your due diligence. You do your final negotiations after that. Draft your agreements and close. It's real simple. It's a six-step process. Okay? So what if you wanted to invest in a fund? Why would you want to do that? Well, there's a lot of advantages of investing in a fund. Passive investment. You don't need to have any experience. Servicing. The fund handles all the servicing. Disposition. The fund manages all the assets. Capital requirements, real minimal. The risk, your risk is the diversification spreads the risk across multiple transactions. So there's a lot of upside into investing in a fund as well. So let's just recap real quick. Okay? Why invest in mortgage notes? Because you want to become the bank. You want to preserve your investment. You want to allow for growth and income. You get secured by real estate, and minimal investment is needed to start, low overhead, and it's available to active or passive investors. That's the end of my presentation. So I guess we're going to open it up to questions now. My name is Rob Napolitano. Again, there's my email and phone number as well. Brian, we're going to swing it back to you. I think I kept it within my 30 minutes that I promised you that I would, so we can open up for some questions.
You did pretty good there for as much content as you had, and
that's right.
I hope everybody was able to catch that. We only have about 10 minutes here for questions, so we're going to try to go through as quick as possible. And if you don't get your questions answered, make sure right now to take down Rob's information, and I'll put my contact information back on the screen soon. So I'm going to go into some of the questions. The first one, how long will it take to fund a transaction? Can I propose to close on a house in 10 days? And I think this is in regards to the IRA question. And the answer is, it depends on how liquid your retirement funds are, because it can take up to a couple weeks to get your retirement funds from your existing custodian over to us. If you have the funds already with us and you want to do a transaction, I most definitely say we could do that in 10 days. So 2 weeks, we could definitely do that. Next question, can you elaborate on the business trust? I'm going to keep it short here so I get some questions for Rob here, but please feel free to contact me offline for questions on the business trust, or check out retirementcheckbook.com. Can someone participate in more than one IRA or 401? The answer is yes. You can have multiple IRAs and 401ks. 12% interest on a mortgage. Yikes. That's crazy. I guess that was more of a statement. Will this recording be available? Yes, it will. I'll be having it. I should have it available by the end of the day Pacific time. So if anybody wants, please feel free to email me, and I'll send it to you. Do you see a peer-to-peer Prosper Lending Club lending moving into this market and cutting profits long-term for individual investors? Rob, that one's for you.
What was that question again? Say that again.
I'll repeat it. Do you see peer-to-peer, and then parentheses Prosper Lending Club, lending, like peer-to-peer lending, moving into this market and cutting profits for individual investors?
I got to tell you that I'm not that familiar with the peer-to-pear, but just from the sound of it, it sounds like if it is what I think it is, where people are putting money in together and lending, you're getting, in my opinion, and again, I'm not an attorney and I don't give legal advice, but so my humble opinion is I think you're getting into securities questions there if you're doing peer-to-peer, and so I don't know that that can be viable long-term and be a real threat in this space if it's not being done properly, because that's going to, in my opinion, that's probably going to have to get regulated by the SEC.
All right. Let me see. Here's a really more complex question for Frank, and I might have to contact him offline. He's asking, what are the pros and cons of simultaneous cash buy mortgage note sale versus purchase of existing notes? And then, for example, acquiring the note position by entering a simultaneous purchase of the property for cash from the self-directed IRA and sale to the buyer with mortgage note financing provided. It's essentially kind of two different transactions, if I'm reading the question correctly, where you're buying property and then you are selling the paper on it.
Yeah, I mean, it doesn't. Yeah, that's what it sounds like as well. I mean, to me, you're ultimately what you're trying to do is, again, you're looking to make money. So depending, if you're ultimately trying to get to the property and take title and ownership of the property, you're either going to do it through a purchase and sale agreement of the property, or you're going to do it from a lien position and go through a foreclosure process. Why? I don't see the advantage in doing both simultaneously when they're both going to get you to the same net result. So, expending more resources and more money to get the same net result, you're doing one of the two paths as opposed to doing them both simultaneously.
Right. Yeah, essentially that's like two different transactions, essentially, in the IRA's eyes. Let me see here. What reporting obligations does the IRA note have? The same as if it was you as an individual investor. You would just direct the IRA custodian to report it. Or if you had one of the checkbook IRA options, like an LLC or a trust that your IRA owned, then that entity would do the reporting. And Rob, I'm sure you know more about the reporting than I do. There's probably a lot of third-party companies that will do that servicing piece for you, correct?
Yeah, definitely. I mean, that's also a tax question as well. So
yeah.
I get my third parties, auditors and accountants take care of all that stuff. I'm smart enough to know what my limitations are and get people that are smarter than me involved in those things. But yeah, that sounds more like a tax question, and should be directed towards a tax professional.
And Rob, just from your experience, how many third-party groups are normally part of a non-performing note transaction? I mean, I'm assuming there's a loan servicer. What other parties are actively involved?
You can do this. You can take on. So if you ran this as a business and you compartmentalized, most of the tasks of the business, you can outsource probably about 90% or more of this business and sit back and just collect payments. It depends on how involved you want to be. I enjoy getting involved with people and being solution providers, so I like being hands-on. So depending on how efficient you want to be and how hands-on you want to be, you can have most of it outsourced and have third parties involved, or you can do it all mostly yourself. I mean, if you can do a lot of complications come in when you're going to get into licensing, and depending on where you're transacting business, some licensing may be issued as well. So there's a lot of considerations that come into play, but you could do and run your own portfolio and service everything yourself if you wanted to. I wouldn't recommend it, but you could if you wanted to.
Let me try to get to these last couple questions. Ask me, can I recommend a couple sources for first and second deeds to buy direct for smaller investors? I can't advise anybody. You might want to talk to Rob about that.
Yeah, that's fine. You can email me. You can see my email address on there. Email me, and we can certainly talk about that, what you're looking for. Again, it depends on what the strategy is and what the appetite is. So certainly email me, and we can certainly have that conversation.
And then this last question I'm seeing here, are you talking about a Reg D security? That would probably be for the fund, I'm assuming, is what he was referring to. He has some money in retirement plan, and he's looking to know what to do. Again, you might want to talk to Rob. I'm not a financial advisor. I can tell you kind of how to make these investments with your retirement fund, but I can't advise on the specific investment.
Yeah, again, same thing. Email me. We can certainly have that conversation. There are a number of different, some are Reg D funds as well. Some are Some are Reg D, some are B. It depends on, again, what you're looking for. There are some smaller funds, some bigger funds, but there's certainly a lot of opportunity out there if you're looking to invest in a fund. So certainly, again, email me, and I'd be happy to guide as best as I can on that.
Well, I think we hit our hour mark here, and Rob, I want to thank you for all the content and for joining today, and for everybody that took time out of their busy day to come on the call. Again, I am recording this, and I should have a recording available later today, so if anybody wants a copy of that, please email me. I'll put my contact information up on the screen here real quick. Before we go, Rob, any last words you want to say?
No, I just thank everybody for taking the time out. I appreciate you listening. And again, if you have any questions, comments, or I like to make myself as available as possible. So just reach out to me, and I'd be happy to help in any way that I can.
All right. Again, thank you, Rob. Thanks everybody for showing up, and it was a good call. And we'll do it again, Rob. Thank you.
Take care.